Perhaps you're looking at markets and your portfolio and you're thinking, wow, with the Federal Reserve continuing to raise interest rates, with high inflation, with the US dollar strengthening, with the ongoing Russian war against Ukraine, and with European energy supplies tight as they head into winter, how should my economic and market expectations be evolving? Stay tuned as we discuss all this and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here with Adrian Nicholson and Erik Olson. We've got another great episode for you today. Gentlemen, glad to have all three of us, although I think we had all three last week as well. I think this is our first streak with two in a row after two at a time. Adrian, how was your week last week?
It was a great week last week, and I'm with you on that. We're on a streak. We're on fire right now, so let's keep the ball rolling with another good discussion. But I had a really solid week. How about you guys?
Yeah, amazing week. Yeah, I'll tell maybe at the end of the episode, I'll share a little bit more.
Awesome.
Sounds good, guys. We've got a great topic today that we're going to talk about, which is really a market outlook or market thesis that we've got, and I'm hoping to share some of these thoughts with Erik and Adrian and have them poke holes into it, which will then cause me to either do more research or to create more conviction, or if I'm wrong, that's okay too. Then I can avoid what could be a potentially costly mistake if I am wrong. So, gentlemen, I'm really looking forward to this today.
Yeah, we're excited to get into it too, Roshan. We're really excited to see what you have to bring. And just for our audience and our listeners today, we're going to be going over a lot of data, a lot of ideas, a lot of investment related topics. So this is all just for informational purposes as well. These are not recommendations. If you do have any questions or any of the ideas we discussed today you're thinking about consider, please reach out to us or any other professional you work with so we can have a deeper conversation to see how this works. So we're ready to get into it today.
Okay, so gentlemen, I'm going to give you the bullet points first. Then I want to go through, really spend more time with each one of these. So I'm looking at the overall like macroeconomic outlook, and then what I think this will do to the markets. So I'll give you what I think are the big picture points. Then let's break down each of them. So first, the first one will be, I think, with the Fed and inflation, they'll get it under control, but it'll require either more rate hikes than initially anticipated. Second, I believe we will truly enter into a recession. I use the word truly because, against using the most basic definition, some would argue we're there already. Three, as we get rate hikes, savings accounts, CDs, money markets, and bonds all become more attractive. Four, the strengthening of the U.S. dollar adds additional headwinds to the earnings of U.S. multinational firms. That'll hurt earnings. All four of these points, the Fed continuing to raise rates, entering a recession, savings certificates of deposit, money markets, et cetera, becoming more attractive, and the strengthening of the U.S. dollar, I think all of those will lead to a continued decline in the market from where we are. We're recording this in early October 2022. So we'll go further into each of those points. But initially, I want to ask, guys, what are your thoughts and reactions to what I'm saying? Am I crazy? Do you see some validity to what I'm saying? What are you thinking?
Adrian, I've got a few thoughts, but you have something.
You can start it off with Erik.
All right. Well, so I first of all, I love the way that you framed it, Roshan, and I love the fact that you've made these sort of declarative statements so that we actually have something to which we can respond. You started out with the concept then of the Fed will have the capacity to bring inflation under control, but that you said that rate hikes, there will be more of them than initially expected. That's the argument, correct? Argument number one?
Correct. Mm-hmm.
Yeah, actually, I agree with that. I have been saying, well, I'll agree with the second part more so than the first part. So what I mean by that is I think that the Fed, in order to tame inflation, will indeed have to implement more rate hikes than they first expected they would have to do. I think it's a deeper problem, and they started late. I've said before that I think that the chief way to address this is through controls on money supply more than it is on skyrocketing interest rates. But I recognize there's some interaction between those two things, but just there are other instruments that the Fed has at its disposal that can limit the amount of cash that's in circulation at any given time. But and deleveraging their balance sheet also is another way of doing that, and they had been doing that since roughly February of this year. Here's why I am. The worry that I've explained to you before is still a worry for me, and that is that I have a fear that the Fed will chicken out at some point. I'm not sure they're willing to press all the way through. And why do I say that? Well, it's one thing is just because I think that the Fed has shown over the last couple of decades they are subject to political pressure. Paul Volcker, shooting rates up to 18%. I don't think that sort of rate hike is permissible in this political climate. I just don't think that would work. I believe that the Fed governors are just too attuned to the political consideration. So that's number one. The second is I think I was made aware of one in Northern Europe. I'm trying to remember which central bank in Northern Europe. Granted, it's small. It's not nearly as consequential as the U.S. Federal Reserve or the European Central Bank or the Bank of Japan, et cetera. But they had announced a 50 basis point increase in their own interest rates. And when push came to shove, all they were willing to do was about a 25 basis point increase. For the listener, what I want to just explain by that one, that's basis point is jargon. What that means is they said a half a percentage point increase is what they were going to do, and they limited it to only a quarter percentage point increase. So that's one data point. It seems as though there is perhaps the first cracking of the resolve at a central bank, and I wonder if that's actually part of the larger conversation. Now, add to that, since I think it's in the last week or so, the Federal Reserve, as you know, is more than just Jerome Powell, and two of the governors, one here, the head of the Chicago branch, as well as the number two, recently have given speeches, and in those speeches have started to highlight in those speeches the recognition that maybe too much too fast is too high, is creating too high a price to pay. So that's why I have some concern about maybe they will chicken out.
Yeah, I understand those concerns, Eric, and some of the term that our listeners and viewers might be familiar with or looking at is a Fed pivot. And that's something that people are just wondering, is it going to happen? What's the time frame of it? It's something that people are really going to look into. And I think if you look at the data when it comes to a Fed pivot, it can highlight some concerning things that I was looking at. If you took 6 recessions that happened, the 6 that I looked at was the Great Financial Crisis, the dot-com bubble, the Gulf War recession, the double dip recession, which was in 1981, and the recessions of 1973 and 1969. On average, when the Fed pivoted during those time periods, it took around 14 months from the pivot to the S&P 500 hitting a bottom. And on average, if you take the decline in the S&P 500 in those 6 recessions, the average decline was around 28%. So historically speaking, if you look at these 6 recessions, if a Fed makes a pivot move like that, that's not really a good sign historically when it comes to the S&P 500, and which are equities in this case. So that's definitely something that people should really look at and be aware of, because when the Fed has constantly been raising interest rates to battling inflation, the markets haven't really been responding well. So people may be thinking, oh, it's going to be a good thing if the Fed makes the pivot and cuts back on rates or just stops this hawkish tone. But historically, that hasn't always been the case.
Yeah, so first, Eric, to your point of thinking the Fed won't have the resolve and comparing it to the past, we have high inflation now at 9%. In the 80s, it was up at 14. So I don't think I see the comparison to Volcker, but I don't think they have to go up as high to do that. Plus, they've stopped this talk because it was proven wrong. But I do wonder if part of the inflation problem is actually transitory with COVID, supply chain issues, and so on. I don't think all. I don't think the majority either. But that point is, it might help them get there faster. So I don't think they can weaken their resolve with inflation high. I could be proven wrong. Political powers and sort of keeping your own job is a very powerful incentive. But I almost feel like their hand is forced. Adrian, to your point, I love the data that you brought today. Just being a data head as I am, I didn't look that up. I'd love for you to send it to me so I can read about it a little bit more. But that seems to be adding to my thought about a continued market decline. That if even they don't have the resolve, as Erik is saying, if Erik, if you're right and they don't have the resolve, that's still a declining market coming through based on Adrian's data.
That's based on what Adrian said. Yes, if that's 14 months average duration of a continued stock market decline, even after they say, okay, guys, we'll back off a bit. Yeah, you're right. That still could mean trouble ahead.
All right. My next point, I'm actually going to change the order a little bit because I think it'll connect better this way. But my next point was strengthening of the strengthening of the U.S. dollar, whether it continues to strengthen or not. People are arguing whether it's peaked or not. I'm not a believer that it is, but anyway, it's gone up so much already that it creates a headwind for earnings on U.S. multinationals. I've seen multiple numbers, but I've seen anywhere from 30 to 40% of S&P 500 earnings come from international sales. So, and we recently saw this hit Nike with the sales decline, with the strengthening of the dollar. So, gentlemen, what are your thoughts on that? Agree or disagree that one, the strength of the dollar will lower earnings? I think that's an easy one. But two, that'll likely be another force to pulling stock prices down.
Well, there's several things that I believe have an impact on valuations of currencies in relative terms. The U.S. being stronger than a basket of other international currencies, or weaker, or moving higher, moving lower. One of those is interest rates on fixed income when investors are frightened. So when investors are frightened and they're trying to say, okay, I don't really want to be in equities. I think I need something that's more stable. I'm therefore going to turn to bonds. They're generally looking at, well, where in the world, which central banks or which stable nations in the world are offering the most compelling interest rates. And right now that still is, for the most part, the United States, because they've been moving forward with the central bank level with raising interest rates faster. So as people say, I want to then invest in treasuries rather than investing in some other bond at some other country, what do they have to do? They have to sell their own currency, buy dollars, and then with those dollars go purchase those treasuries. That action of selling their own currency to buy a US dollar drives the dollar higher. That's one influence there. I don't know that that's going to end anytime soon. It does seem as though the European Central Bank has been slower on this. I thought the Bank of England might be actually ready to raise interest rates, but what that did is set in motion a really big turmoil here within the last 3 weeks, 4 weeks. So there again, I'm not entirely sure whether that will persist. Finally, the last thing I'll say about these currency movements is, among trending asset classes, this isn't a rationale for it. It's just an observation. Historically, the trends in currencies, they are some of the strongest and most persistent trends out there. So I could see this going on for quite some time.
I think an impact and the global conflict overseas, the war in Ukraine, will have a more significant impact, because that's definitely one of the big macroeconomic events that people are also looking at as well. That's really shaking up people, like you said, flooding to safer assets, just concerned with all this going on. That's definitely ties into all this as well. And just touching on a little bit deeper when you said how investors are flooding to bonds. The type of bonds they are doing are these short-term bonds because they don't want to lock them up, and it's driving the prices up on this as well. And just what people have to look at and consider is how long are they going to maintain these high level prices? Is this going to be something where people look at other opportunities in other spaces? All this really just gets baked into it.
Well, I agree with the point that you made there, that the conflict in Ukraine and the impact that all of the conflict has had on energy markets, which I don't know if you mentioned that explicitly, but certainly it has, is having a bigger impact on European businesses than it is on U.S. businesses. And that's certainly true. I've heard of, in some cases, the energy restrictions in Europe are so tight that some businesses are simply saying, we don't have the power to heat our restaurant or to fuel our stoves or, these sorts of things. And so we're just basically shutting down. And of course, that's more a street level change as opposed to necessarily a macro or a major industry. But the point is that the stability in relative terms of the U.S. economy relative to the European economy, I think you're right, Adrian, could further serve to reinforce the strengthening dollar. Having said that, I'll mention just one more thing. Barron's last weekend, I think it was, had on the cover, it had George Washington sort of flexing as he, coming out of his image on the front of a dollar bill. The point being that, now the financial press is noticing the strength of the dollar. A lot of times, the very moment that the press starts to notice something is the very moment that the ride is over. So possibly that's the signal or the trigger that we've reached peak dollar. I don't know, but I still go back to my earlier arguments, but I do think it is kind of humorous that that's now reaching the public press.
Yeah, I was actually thinking different, just with Adrian, your point of the war and energy restrictions. I didn't actually include this on one of my points, but that I think would be a further potential driver to equities going down. Is just energy prices continuing to go up, leading to further inflation, further potential Fed tightening. And I saw an article on Bloomberg. It says UK shoppers snap up blankets and warm clothes for a difficult winter. I mean, we talk about energy prices going up, but natural gas prices they've tripled to quadrupled, I believe, in the last 12 months. I'd have to look up those numbers, but they've gone up and it's harder for us to transport natural gas over to Europe from the United States to help them out. So that is definitely another big point. I'll saw one other data point on the dollar, and then we'll move on to the next one. Is just for this quarter, this was from a Bank of America securities analyst named Osung Kwan. Their expectation is that 5 to 6% of earnings in the S&P. There's a loss of 5 to 6% of earnings in the S&P for this quarter, based on the strong dollar. So, Erik, if we take your point of the currency trends persisting for a while, it's a potential 20% decline in earnings for S&P companies.
Well, I think that's a fair point. It really is a fair point. And just since we're talking about earnings and we're talking about the most recent quarter, earnings as a whole on the S&P, if I'm not mistaken, in the third quarter were up 4%. But energy companies were, if you took energy companies out of that, or the energy sector out of that, actually earnings were down. So energy was the one really bright location for earnings growth last quarter. It's a trick here. From a policy level, I think I don't like to make this a political show, but I think it's nutty that the administration is out begging Saudi Arabia and Venezuela and other members of OPEC Plus to turn on the spigots, and then just getting stiff-armed and ridiculed when you have the same capacity to increase production here in the United States. And instead, I just think if you're thinking about in terms of global carbon output, does it really affect if your thesis is that carbon is going to contribute to climate change, then does it matter if it's Saudi and Venezuelan oil that's doing that or U.S. oil that's doing that? It just doesn't seem it doesn't seem like there's any logic. It seems like it's mostly political posturing, and I think that sort of unseriousness about what's taking place right now is, I'm not going to say dangerous, but I think it's foolish. And it does mean, I believe, that the road we're on is probably longer and more challenging, precisely because of those kinds of policy decisions.
Yes, something people are looking at is our petroleum reserves as well. And I'm looking at some data as well, and it looks like oil prices and gas prices are trending up now, which is something that investors were hopeful a couple quarters ago that they were going down, but now they're starting to trend up. So this is another area that people just need to be aware of. We're going to start seeing some improvements. So thanks for mentioning that, Erik.
Yeah, I was hoping you guys would tell me I'm crazy, but you're starting to make me feel pretty good about this thesis. I'm going to continue on to the next point that I had said. As I mentioned, I did go out of order intentionally. So with these earnings slowdowns, I think we will enter a recession, and it's not just because of the earnings slowdown, but in general I think we will. But the one major piece that's been missing is the strength in jobs. So you get you get corporate earnings weakness, you get jobs impact jobs, and then we are in a recession, which I also think is bad for the economy and the markets in general. I'll give you one more data point, and then I'd love your thoughts on it. But prior to 2002, there've been 13 rate hike cycle. 2002, excuse me. Prior to this year, 2022, there have been 13 rate hike cycles. Out of those 13 rate hike cycles, our listeners may remember hearing the stat before, but there have been 11 recessions. So looking at that point, we're in a rate hike cycle, and the likelihood of the Fed to get it this time, where they are in the 85% of the time it's led to a recession, the likelihood of them being the Fed being able to thread the needle and be in the 15th percentile where there's no recession, to me seems incredibly unlikely. I wouldn't call it impossible, but right next to it.
Yeah, I am. As listeners have heard me say before, I'm something of a fence sitter on this question about whether or not we're going to enter into a recession of the kind that we usually, of the type that we usually mean when we say recession. And that is one that includes not only earnings declines, but layoffs and high unemployment as a result of that, and so forth. It is certainly the case that monthly employment or new jobs have been coming down. I think it was for at least the first half, maybe a little bit longer than that, of 2022. I believe we were at about 400,000 new jobs per month, and more recently, the September numbers that came out for August, I believe, or was it? No, actually, it was September numbers, I think, said that it was down to 260. And that had followed a decline in the month before as well. So maybe the job market is cooling, but it is still new jobs, as opposed to unemployment claims aren't really spiking. It's a very odd, if this is a recession, it seems like a really odd type of recession. But based on some of the other things that we've been talking about here today, my view about this is certainly changing over the last few weeks in particular, and maybe over the last few months. And I just want to say to our listener as well that, here we're supposed to be financial advisors. We're supposed to have insight into a lot of these things. I just want to dispel that myth. We have a certain amount of insight into things, but mostly what we have is a recognition of the uncertainty of things, and the willingness to be wrong, and the willingness to take on new data and revise our outlook on things and help you navigate through that uncertainty to your final goal. So it's really not. I'm not in any way afraid of revising my outlook. So I'll just inject that as an aside. But again, on this note,
Erik, that was a great point. I want to interrupt you just because this was not my outlook 2 months ago, 3 months ago. What really shifted my outlook. What's interesting is I didn't have a dissimilar outlook. Probably back in roughly June timeframe. Then the market bottoms and recover. We get some positive inflation number, and I thought maybe I was wrong. Then September, we get the data from August, which in my opinion was the worst inflation report of all of them. Not just because of the increase, but because of the breadth of the areas we had the increase, and that got me to have a more bearish outlook than I've had at all. So your point of it changing with the data, I think is accurate. What that outlook and that report has done for me is two things. One, it's caused me to revise. I'm sorry, that data point, that inflation number, caused me to revise my outlook, dig deeper, and do greater research. First, and second, it's put me to the point where I'm really waiting for Fed policy shift or data, as opposed to being what I'll say as part of the crowd that, in anticipation of a change, is adjusting the equity exposure. And how that's different is I'm willing to miss a part of the upside if I'm wrong, because I think the downside is greater. Well, and the point where I'll say I was wrong is if the Fed comes out and say, okay, we're slowing things down, or their actions show that inflation comes down, some data as opposed to market speculation.
Well, that's interesting. There again, we're aligned. Not for every single one of my clients, because some of my clients, of course, have really long-term investment horizons, and in their cases, we're not needing to be so adaptive, I would say. But for those of my clients that are in retirement and making significant, it's important to them now to make withdrawals from their portfolios. One of the things that we've been doing is, if they were if they were starting to see that their retirement withdrawals might be jeopardized at some level by if there was a prolonged downturn, we have in their cases at least had the net equity exposure dialed down pretty significantly, maybe to the 20% level in a lot of cases, precisely to try to mitigate some of what may be prolonged equity downturn in particular. That, by the way, when I say that, I don't mean to imply that there isn't the possibility of more bond downturn as well. But in least given the scenario that we're in right now, it seems as though the equity downturn would be, if that equity downturn continues, which I think is a reasonable thesis, that it would be faster than bond downturn.
That would make sense. Interestingly, I literally looked at the 20-year Treasury versus the S&P and the NASDAQ. The 20-year Treasury's decline is in line with the NASDAQ, which is greater than the S&P's this year, which is why this has been such a I look back to 2008, and this, I'll go back to how this affects Fed policy, but I look back to 2008, and yes, stocks were going down, cash was going down, but your treasuries were making money that year because of the flocked quality. But when you've got this interest rate hike driving things down, it's causing everything to go down. So you're really only flocked quality this year, or flocked quality is a bad term. You're really only respite from the decline would have been currency or energy. That's pretty much it.
Well, that you've made a good point there, in that you talked about the 20-year. So just our listener, just to understand again, as we've talked about in the past, the longer the maturity, the more the more time that must transpire until a bond matures, the more it is, all else being equal, subject to interest rate risk, we say it, or it's the influence on price from every incremental increase in interest rates affects long dated bonds much more than really short dated bonds. And for that's been the reason that we have not entirely, but almost entirely stayed away from the long end on bonds, at least in my practice. So we've been much more, to the extent that we do have bonds, we've had intermediate term and short term bonds as our preference. And as we've talked about since Adrian and I did this episode, I think it was in November of last year, really also been turning more and more to some bond substitutes that don't have that the sort of vulnerability to those ongoing interest rate increases.
Well,
Yes,
just
understanding the risk.
I'm sorry, I just want to add one data point to your intermediate term bonds. The intermediate treasuries are down 17.5% as well this year.
Well, so
So
look at the
yes, better
aggregate
than
bond
long.
index and then compare that to the S&P. You're right. It's not a great year for, actually, we've had this conversation before, haven't we? So I haven't updated my research on this to talk about the first 3 quarters of the year, but I think, as we've said before, the first 6 months of this year for bonds were the worst since the Bloomberg Aggregate Bond Index has been created. And one enterprising researcher who went back much more deeply into history of bond prices said it's the biggest in 6 months start to a calendar year, the biggest decline for bonds in a 6 month start to a calendar year since 1840. So
Wow.
this is a confluence of declines in both stocks and bonds that doesn't usually happen in this way. The diversifying effect of those two asset classes is just not there.
Yeah, the inverse relationship that they used to have historically isn't really showing this year, because normally or typically as interest rates increase, bond prices go down, and equities tend to have an inverse exposure to that as well. So you're not seeing that correlation there. And just touching on what you guys just really described is understanding the risk component of your investments and the different asset classes that you have within your portfolio is extremely important. And just to see what other data or what macroeconomic environments are going to happen that can impact your investment is something that you really need to look at. And having that short-term or long-term horizon too is also a very important aspect of this as well, just to see if you need to make adjustments or where you're standing right now is all really important here.
Yeah, that I completely agree with you. And even the bond inverse relationship, that's something that we haven't had too much of because of the low interest rates in a while, which leads me to my next point, which is that we haven't seen rates like this in things like bonds, savings bonds, CDs, etc., since roughly '08, right? So I think now people have an alternative. So if you're an investor that uh, has seen these declines in your portfolio, and you look over and you say, well, I can just get a bond now that'll pay me 5%. That might be an attractive alternative for you. If that is the case, if that is an attractive alternative, you might then rotate your money out of stocks into bonds, causing a further potential decline. Just stocks are now less attractive than bonds because the rates are higher, which could cause a further decline in stocks. So that's the other point I had as far as stocks looking like they're going to decline further. Gentlemen, what are your thoughts on that?
Well, 2 thoughts. One, and this is just going back a few paragraphs in our conversation, but we should emphasize that when we're talking about the declines in bonds since the start of the year or since their peak values and such, it's important to emphasize that that isn't consequential for the person who bought a bond and then is going to hold it to maturity. So if they hold a bond to maturity and don't worry about what their paper statement says the bond that they're holding to maturity might be worth today, they will indeed, if they purchased, let's say, $1,000 bond at some interest rate at some point in the past, whether that was a corporate bond or a government bond, barring of course a default by a corporate issuer of that bond. But if they hold that bond to maturity, they will get their money back. Now, the interest that they might have been paid on something that they purchased, let's say, a couple of years ago, is going to be considerably lower than the interest that they would be paid on a bond they'd buy today. But buying a bond and holding it to maturity means that, especially if it's a treasury, you don't really have to concern yourself with, wow, they're declining in value. Yeah, you're going to get your money back. So I think that's one point. The second point is, we're talking about correlations, and it is actually, if I recall correctly, and I've seen this graph a few times, but at lower interest rates, there is in fact a good diversification between bonds and stocks. At higher interest rates, there's less good diversification between them. So and I'm not going to get into all of the reasons that might be, but as these interest rates increase, then it may very well be the case that from a price standpoint on those bonds, the movement of the prices of the bonds and the movement of the prices of the stocks could in fact be less inverse than is normally the case when you have very low rates.
Well, and with what's going on right now, it lines up. And Erik, I've seen different research. I wish I could remember the numbers, but it was something like you have between something like 0 and 3%.
Mm-hmm.
You've got a diversifying effect.
Mm-hmm.
Between 3 and 6, you don't, and then 6 and above, you do again. Something like that.
Okay.
Don't quote me on the numbers,
All right.
but I've seen it broken up those three ways. I need to look into that further. But if you think about what's going on right now, as the Fed raises rates, well, what happens to bonds? Bonds prices go down, the inverse relationship between yield and price. As the Fed raises rates, what happens to stocks? Well, stocks prices go down. And I think that's a part of this this diversification factor that you're seeing. The impetus or the cause of this is something that would lead to declining prices in both, and that's what we've experienced this year. One interesting data point that I found, and the chart, it was kind of hard to read because of the way the key was and it was laid out in the chart. But roughly, the last time we had bond yields this high, the S&P declined to about a PE ratio of 15. So from where it is right now, that would be another 24% decline. Now, using that Twain quote, I like history doesn't repeat itself, but it rhymes. We may not go down to 15, but I believe the direction will be the same. And that doesn't include the fact that the potential for corporate earnings to decline. So if we were to go down to 15 and corporate earnings were to drop by any significant factor, well, it's a longer trip down to a 15 PE with lower earnings than with the same earnings level. So that's potentially another big risk to the downside.
Well, so you've heard the acronym TINA. So for our listener, TINA is there is no alternative. There is no alternative, TINA. What that means is that when bonds, for a long time under the quantitative easing policies of the Federal Reserve, were offering essentially no real compensation for owning them, what incentive did a retiree have to own those bonds as a source of generating income? Well, almost none. If you had, for example, once upon a time, a bond portfolio might have paid you 6%, then you had $1 million portfolio that would pay you $60,000 a year. If it's paying you 1% or 1.5%, you're talking about that $1 million portfolio of bonds that's generating that is paying you $10,000 or $15,000 a year. And you're probably thinking, wow, I saved $1 million for my retirement. And now here I'm being paid this paltry amount in historical perspective. So people would say, on that basis, I can't afford to be in bonds, and hence I'll sell bonds and I'll go buy stocks, driving the valuations of those stocks higher and faster than their earnings were growing. And what you just explained, Roshan, is now it may be that indeed there is an alternative. So instead of TINA, it would be TIA. So maybe something like that.
There is an alternative.
There is an alternative. So you sell the stocks, just to your point, and that thereby reduces the multiples on their earnings to a more reasonable valuation at the very same time as their earnings might be dropping.
So gentlemen, we've covered all the points in my thesis so far, and I was hoping I was wrong and things would shoot up right away, but you are not making me feel like that at all. I think we've agreed on part of it. There's one final point I'd like to make and get your thoughts on. With all this going on and all this concern, there are some really good deals in stocks right now. Right. So I've had this conversation with multiple clients saying, if my only choice was to either buy stocks and go to bed for 10 years or not buy stocks and go to bed for 10 years, I like the buying option. Right. But I'm concerned about the macro environment. Will these stocks go down as the markets go down and get cheaper? So that's the quandary. And as I said that reminds me of Adrian's statement earlier. This is informational purposes only and not a recommendation. As you can see, I'm on the fence with this answer. I would just love your thoughts on that. What does someone do in a situation where you think the markets are going to go down, but there are some good deals out there?
Well, I guess the best way for me to answer that, and Adrian may have a different answer, is to say what I'm actually doing. So as I've mentioned to you, our listener, on multiple occasions, one of the things that I do is run some stock models. And those stock models, when they can't find anything that meets the tests of attractive valuations, of high quality, and other sorts of factors, they just then say, okay, there's nothing out there for us to purchase right now. And so they increasingly go to cash. Those models, at least one of them, is getting closer to the point where it's finding it hard to identify things that meet the requirements, but not necessarily on the quality and value measures, more on some of on the trend and momentum measures. So on that basis, as I continue to work these stock models, they're continuing to find things that they like and jettisoning some positions that they don't like. And so I guess I would say, if I just observe my behavior instead of my profession about what I believe, I apparently believe that there are still reasons to find some stocks that are worthy candidates for incorporation into a portfolio. I will say, in just making an observation about them, they tend to be of very high quality right now. And many of them tend to be showing earnings growth rather than earnings contraction. And as we said just a few minutes ago, much of the sectoral concentration of earnings right now is, not surprisingly, in energy. So I've seen more materials and manufacturing and energy, sort of basic companies, as opposed to tech companies or things of that kind, that are the ones that tend to be the ones surfacing most these days.
So Erik, to make sure I understood that, your models are saying the momentum looks poor, but quality looks good in the stocks. Is that in some of these stocks? Is that correct?
Yes, still many of these stocks are still satisfying the stringent quality tests that I apply, and also the attractive valuations against their earnings. So I would say the emphasis I see that is working in my models right now is a turn to quality and a turn to dividend payers and dividend growers.
And you run multiple models? Have your momentum models? What are those showing? Because just your stock models are showing moving to quality, and there isn't great momentum factors. What are your momentum models showing?
The momentum-based models, the ones that are purely momentum-based on asset classes, have rotated, again, not surprisingly, into the U.S. dollar to a large extent, and in some cases into energy, but more recently into the MLPs. So these are for people who are saying, what's an MLP? These are the companies that are sort of, they run the pipelines through which the oil and natural gas flow. And so they charge a delivery fee. It doesn't matter if the prices on that energy is high or low. They're essentially charging the same a toll, if you will, like a highway would do. And so the more traffic there is that's flowing through, then the more they're compensated. So that the operators of these MLPs, these master limited partnerships, these pipelines, those have surfaced as some of the more investable categories right now.
Interesting. And what about cash? Are there a lot of cash in some of these portfolios?
In the pure momentum model, as opposed to the stock model, so pure momentum model is really using it's using ETFs to express these ideas. That has had over the recent months, because many of the candidates that otherwise might have been the leaders just had broken down too much on a price level to be appealing. So it had at one point as much as about 2/3 of the portfolio in cash, but that's been inching down, down, down. And I think we're now on that at about 20% cash, something like that. But the stock models that include, not all my stock models include momentum, or at least not a heavy dose of it, but the ones that do, those stock models still are fully invested. They haven't started to say, hey, we need to move some of this money to cash, because there's still enough opportunities out there to meet the test of what we're looking for.
Interesting. This has been a great conversation, gentlemen. I personally enjoyed it a lot and had fun going through this. Do you have any points to add to this?
Yeah, I mean, what you guys talked about and what Erik just mentioned, Roshan, you talked about clients buying stock and then going to bed and waiting for 10 years or not. And just my take on that is, what are you buying? That's just the big thing, because there are a lot of different stocks out there, a lot of different companies out there, and they're all different in different sectors. And just looking at the fundamentals, do they have strong earnings? Are they making money? Do they have a positive outlook? Are they in an attractive, competitive environment? These are all pieces of data that you have to really research and look into, where we talk about that's where you can find the opportunities there. I think that's just the point we're trying to highlight there.
Yeah.
And I guess go ahead,
please,
Roshan.
Erik, continue.
Well, just my concluding thought on this is just we entered into this conversation trying to have a conversation to see if perhaps we had differing views on the 6 or 7, 8 various theses that you advanced as sort of our starting point for our conversation today. And what I think we found is, as you pointed out a little earlier, there's a lot of alignment in our outlooks on many of these subjects. But that just to highlight the point that we made earlier, this is an environment of uncertainty. In fact, that's just the constant state of affairs when it comes to markets and economies and life in general. It is where we as human beings crave certainty. We want to have answers. We want to have pure, firm knowledge and bankable answers. And we look in many cases to experts, whether that's a doctor, a CPA, or a financial advisor, to give us certainty. Our job really, I think if you have a financial advisor who is professing that they can give you a certain answer, you should question whether or not they have an awareness of just how much uncertainty there actually is at all times in the world in which we live. I think the better way to think about interacting with someone who is providing advice to you in this way is to see them as someone who is paying attention to all the environments of uncertainty, and then helping you make what I would say sort of short-term adjustments in alignment with that uncertainty to continue to incrementally get you closer to your long-term goal. And as you get closer and closer and closer to that long-term goal through all those rounds of uncertainty throughout your lifetime, then hopefully you'll wind up in a better place. I think you will wind up in a better place than if you didn't. But to assume that there can be complete certainty, and to whatever extent perhaps our industry or members of our industry convey the idea that we can provide you with certainty, that's a false claim.
That's for sure. One closing point I'd like to make as well that's worth looking at, because we talked about strategies, we talked about the S&P 500 and ETFs. I've also seen a lot out there saying that we're now in a stock pickers market, meaning that selecting individual stocks may be a better move than the indexes were for you or have been previously. So that, I think, for anyone listening to this to try to gain some insight to determine, use this as an additional data source for what they're planning to do. It's another thing worth researching and considering is is this a stock picker's market versus a market where you can just index?
Well, that's particularly true, Roshan. That's an excellent point. I think that's particularly true if you think about the composition of the indices today. Let's take the S&P 500 or the NASDAQ as examples. They are dominated by a few big names, and those few big names are predominantly tech stocks, and those tech stocks have relied on to a large extent on their success, or at least the price of those tech stocks has relied to a great extent on low interest rates, which means that their future earnings can be expressed in today's money when the interest rates are low as quite valuable. But if you use a higher discount rate, meaning a higher interest rate, those future earnings can't be regarded as valuable today as they would have been in a low interest rate environment. Hence, that puts pressure on them. And if your index is essentially dominated by these companies whose prices are under pressure in the environment of higher interest rates, I believe that what you just said is that the indexing idea, if it's market cap weighted, is at this point probably going to present more challenges than it had in a low interest rate environment.
Yeah, and you mentioned that. I went and looked it up. The 1, 2, 3, 4, 5, the top 5, technically 6 names are all tech stock. The reason I say 5, technically 6, is because they include both share classes of Alphabet or Google,
Mm-hmm.
but and
Mm-hmm.
25% in tech. So you've got a pretty big exposure there. So, and you had talked about this earlier, but energy, which used to be a really big component and which has done well this year, is only 5% of that index. So uh, I think we left a lot of information out there for our listeners to think about, reiterating what Adrian and then I followed up with. This is for informational purposes only. We're hoping to give you things to research and think about. Please reach out to us if you'd like to discuss this further. Reach out to your financial advisor. Like, subscribe, give us 5 stars, tell your friends and family, and we'll be back next week with another great episode of the Retirement Lifestyle Show.